Welcome, everyone. We're so pleased to have everyone here with us today to kick off Gallagher Talks. We're thrilled to bring our top experts from across the country today to explore topics in construction, captives, real estate, and more. This first session we have is around Canadian market trends and projections, and we'll offer you guys a Canadian perspective on today's markets and the expected impact of global trends while leveraging data and market insights. I'm pleased to introduce our speakers today, Dave Partington, our CEO here in Canada, along with Kevin Neiles, our Chief Markets Officer and leader for the Western region, coming to us live from Winnipeg. If you would like more information on these two gentlemen, please feel free to click on the right of the screen and connect with them on LinkedIn. A couple more items before we get started. You will receive a recording of this webinar following the session later this week. Because of the fast-paced nature of today's talks, any questions from our clients and prospects who are listening in today will be addressed and responded to several days following the Gallagher talks. And for anyone on the line who's having technical difficulties, please use the question and answer box and we will reply and troubleshoot you there. We hope you enjoyed today's topic. And remember, if you are on LinkedIn or Twitter, please share your experience with people using hashtag Gallagher Talks. I also wanted to mention we have 10 more sessions today, and after this one taking place throughout the day, covering areas such as transportation, real estate, black swan events, and more. Just follow the link that will pop up at the end of this session, and it'll take you to the next one. Without further delays, I'd like to pass it off to Dave and Kevin to get things started.
Thank you, Tyler, and welcome everybody. And I really appreciate everybody taking some time to listen in and look at this webinar. As Tyler mentioned, this is the first of 11 Gallagher Talk sessions today, and we're excited to share, on a number of topics, as Tyler mentioned, from trucking trends through to captive insurance, how surety can help your business, and beyond. But this morning, first up, we're going to talk about the Canadian insurance market, what's happening right now, and what we see happening in the future. But let's start by giving you a little bit more of an introduction. So I'm Dave Partington. I'm CEO of Gallagher's property and casualty business in Canada. To give you some perspective, our business employs 1,000 insurance professionals across 28 locations in Canada. We are honoured to handle the insurances for tens of thousands of small businesses, medium-sized businesses, and large corporations as well. We're also lucky to be part of a global corporation where we have the ability to access resources and insurers right across the world. Kevin, over to you.
I'm Kevin Neiles. I'm president of the Western region for Canada for Gallagher, and I'm also the chief markets officer. And what that means is I have the responsibility for our relationship with all our domestic and international carriers, and that we really access for our clients. And what that connection with them does is it gives me insight into industry trends, and I spend much of my time actually helping negotiate deals for individual clients. I've been working in the Canadian insurance market for over 30 years now, so I've seen a few market cycles in my career. However, to quote one of my colleagues who has over 40 years of experience, I have never seen a market quite like this. We will talk more about this over the next 30 minutes or so.
Yeah, appreciate that, Kevin. So what we want to do this morning is share three things with you, really. We want to look at, kind of what is happening in the market now and what we think will happen in the future. We're going to share with you some of our data as well to give you an insight into what's actually really happening. And then finally, look at some of the strategies that can be used to manage the market and get the best possible results. It's worth saying that, as Kevin said, the market is really tough right now, but there are successes that can be had out there, and our teams are fighting every single day to get the best deals for our clients of all sizes and across all industry segments. So we feel confident that we can get results for our clients, but we are incredibly cognizant that it's tough out there and tough for insurance buyers. So Kevin, tell us kind of what you're seeing right now in terms of the major issues facing insurance buyers.
Well, essentially, there's challenges now with regard to increasing rate for sure. And, from a client perspective, no clients like to see that. While rate is a big issue, difficulty in accessing adequate capacity for large complex risks, and also the impact of COVID-19 on the insurers and the marketplace in general. So those three things kind of are in concert, really, really impacting the market.
Yeah, let's explore each of those in turn. So, you mentioned rate pressure and increasing rates, and anybody that's buying insurance right now will understand that. Give us a little bit more context.
Sure, Dave. As I mentioned, that this really is the toughest market we have seen for many years. Up until about 2017, we had over a decade of soft markets with rates either coming down or staying level. However, over time, the rates being charged by insurers really didn't address the things such as increasing claims costs, increase in the frequency and severity of catastrophe events, and also, very importantly for the insurers, the reducing return on investment income. Those rates continue to decline. So as a result of those factors, the market took a very hard turn in late 2017, particularly in realty classes, condo and residential realty, and then really expanded to other classes in the second half of 2018. We've seen rates rising in all classes over the last 24 months. And despite these increases, Canadian insurers as a whole still have not made money. The combined operating ratio over the last 2 years is over 100% for the industry. And for those unfamiliar with combined operating ratio, it's really the cost of claims and all insurer expenses relative to premiums. So if that number is over 100, the insurers are losing money for every dollar of premium they write. So that's really an indication of why rates are still continuing to increase.
Okay, and we'll very shortly drill into kind of each class of insurance and look at what's happening in turn. But maybe firstly, make a couple of comments on restricted capacity.
Sure, Dave. For many years, capacity was not really an issue because there were many insurers willing to write risks. The London marketplace was very aggressive in Canada, and insurers wanted to use as much of their capacity as they could so they could write 100% of large risks, and we're doing that. However, over the last 24 months, we have seen insurers less willing to write certain types of risks and less willing to put up large lines on those risks. So this is making it much more difficult to fully insure larger risks and creating a further impact on rates as well.
Yeah, and that's another subject we'll drill into a little more as we move through. What about the impact of COVID-19 on insurers in the marketplace?
Well, Dave, there's many impacts, and we'll dive into them a little bit further. However, for now, I'd like to note some of the impacts that are obvious and maybe a little more subtle. Right now, there's a focus on policy wordings. The thinking was some of the existing wordings, particularly on program business, were a bit ambiguous where it comes to pandemic cover. So really, there's a push driven primarily from reinsurers to be crystal clear in these wordings on what is covered and what is not. And many clients as well have seen their operations changing during the pandemic. Businesses were forced to close down or at least reduce what they were doing, or in some cases, businesses were repurposed to help fight the pandemic. We really needed to make sure as a broker to make sure that we reach out to the insurers to ask for relief. But at the same time, we wanted to make sure that the coverages that our clients had matched the changes in the situation that they were in. Also, the ability to access insurers now that they're home-based, and it makes it difficult to do risk surveys and inspections and whatnot. So it's, as much as the insurers and us as brokers have tried to maintain business as usual, it still creates complications.
So it's fair to say between rates, capacity, and COVID, it's a pretty challenging time right now.
Yeah, definitely it is.
Excellent. So let's drill in by line of coverage and show what we think is happening in the market right now. The next slide is going to show you the rate change data as we see it, and this is the changes that we've seen on a rolling 12-month basis to the end of Q2. Again, I'd like to drill into this in a little bit more detail. So Kevin, first up, tell us a little bit more about what you're seeing in property insurance.
In property insurance, we're seeing probably the highest of increases. The extent of the increases are, as much as 50% and more in certain cases. It's, the residential realty of all sorts is taking the highest hits, and then some other factors such as construction, loss result, all those underwriting factors all play into it. The property, quality of management of the property, and the size as well. The largest of risks seem to be the most difficult and seem to be having the highest rate increases.
Yeah. What about in the casualty lines?
In the casualty lines, it's driven more by what the businesses are doing, and some of the higher risk casualty businesses are really having higher rate increases. Things like post-liquor liability. One that's really, I find ironic is landscapers, and particularly if they do snow removal. I mean, snow removal, we need 7 months of the year in Canada. I might be exaggerating a bit, but it's almost impossible to place the coverage right now. Roofing contractors always have been tough, but the rating increases are a little higher right now. And a lot of this business is seeing 50% plus rate increases, and in some cases over 100%. And typically, a lot of these higher risk casualty accounts, in the past we've placed with managing general agents or MGAs. And one of the problems that the MGAs are facing right now is they're having their capacity clawed back and their ability to do things, particularly they've had a lot of they have a lot of their capacity in London, and London is really curbing that capacity. So the MGAs are looking to place a lot of this domestically, and some of these high risk exposures are just not able to get the coverage that they're looking for.
Yeah, I mean, I'm really thinking that after a punitive 24 months of looking at property rates, the insurers are really putting liability into their, in their crosshairs right now.
Yeah.
What about commercial auto?
So this is another challenging sector, and I'm going to start sounding like a stuck record here, but really what we're really seeing that has just come to the forefront in the last 12 months or so is the lack of capacity in the excess and umbrella market for transportation type risks. And I mean, it really is critical for larger transportation firms, in particular long haul trucking operations that are going to the U.S. where they need the higher liability limits. And it seems that markets are just pulling out of that class, and it's very, very tough to find anybody to step in to pick up that void that's created by the markets pulling out.
Yeah. Just a quick thought here at 9:45 Eastern time. Joe Palmer, who's our industry practice leader for transportation, is going to be doing a Gallagher talks on exactly this subject. So if that's something you're involved in, then I would urge you to listen in. Let's talk about management liability. I've been personally involved in a couple of placements recently that have been incredibly tough. What are you seeing, Kevin?
For sure. It's funny because a few years back, there were a lot of markets that entered into the D&O market in particular, and we had a lot of choices. Now that's starting to change rather considerably, and there's kind of two different aspects. One is in the privately held companies, we're seeing increases, but those increases are predominantly for reasons of employee claims, employment practices liability. I think the COVID environment is having even more of an impact on that. But those frequency of those employee-type claims are driving things up. On the publicly traded business, it's a whole different story. What we're seeing almost in all cases is that once somebody lists, inevitably, that's the first sign that there's going to be shareholder suits in the not too distant future. So, oftentimes, although the businesses are very excited about listing and raising capital for their business, it has the opposite effect on insurers. Insurers are kind of turning away and say, hey, let's wait a little while and see where this goes, because inevitably there's going to be some claims. And that's both driving the availability of that coverage and therefore the cost of that coverage up rather considerably.
Yeah, good observation.
And then we're actually really having to, in order to place coverage in these areas, we're going to have to use a variety of different avenues, including domestic carriers, U.S. carriers. We've been in the Bermuda marketplace looking at reinsurance as excess and have to put the fronting together, and it's very, very difficult. But we're having to become creative in particular in the management practices side of things.
Right. And we didn't specifically call out cyber liability in the rate increases by line, but what's happening in cyber liability? And by that, I'm talking about insurance against data breaches or infection of systems by viruses.
So cyber, it's still a relatively new insurance in the marketplace, but what we're finding is over the last 12 to 18 months, a lot more of our clients have been purchasing this coverage. And as a result, there's more exposure to claims, and we are seeing more claims, and we're starting to see the size of the claims, the scale of the claims, and what's all involved in dealing with these claims. And as well, there's just seems to be so many more cyber incidences happening, so many more phishing emails and that sort of thing. So it's really requiring that clients have a lot of risk management practices in place, but it's also driving up the premiums rather considerably in this sector. And it's still kind of uncertain as to how much, but we're seeing 30-40% increases quite regularly in this area.
Yeah. And again, heads up that it's 1:30 p.m. Eastern. A couple of our experts will be looking into this subject, and whether you buy the coverage or not, whether you're in a technology business or not, I would urge anybody to listen into that. So moving forward, so far we've been talking about rate. I'd like to share some information about what's actually happening to premiums, and for everybody out there, you will understand that premiums are, an impact of the exposure units and then the rate as well. So the next slide is going to show the consolidated data for all of our commercial clients across all lines for the 12 months to the end of Q2. What you can see in this chart is in the dark blue bar, you're seeing the average premium change, basically running from Q3 2019 through to Q2 2020. The light blue bar is showing the median change, and the red line is showing the 75th percentile, so the more extreme changes. If you move over to the right-hand side, you can see the average rate increase in Q2 2020 was 5.5%. And Kevin, I think there's a couple of things on here I'd like to drill into and get your take. The first thing is the average premium increase at 5.5% seems to be a bit lower than maybe the rate increases that you were talking about on the previous slide. Can you give us some kind of context to that?
Yeah, that's a good point, Dave. It's really worth noting that just this chart includes all of our clients, and our small business clients are not seeing the rate increases at the same pace that larger clients are. Underwriters are certainly spending more time reviewing large files and trying to deliver terms and whatnot, but these terms seem to be driving increased rates.
Yeah, makes sense. And I think the second observation is, in Q2 2020, we've seen a drop in average and median premium increases. What do you think is driving that?
Well, Dave, there's really two factors at play here. As you noted, premium is a factor of exposure as well as rate. So, the first factor is rate. We do believe that increases are slowing, but they're still increases. And you have to remember, many clients have seen, in some cases, pretty large increases over the last 1 or 2 years, and underwriters are now becoming more comfortable that their portfolios are becoming closer to correct pricing. And, we hope that this becomes a bit more of a positive story for our clients. Second factor is exposure. And in Q2, of course, we saw more of our clients reduce exposure. A lot of them had to close down, take trucks off the road. Their businesses had slowed down considerably. Some businesses were closed, employees were laid off or furloughed, and sales revenues were reduced. And that had and continues to have an impact on premium. And, of course, we work hard to ensure our clients are buying the correct level of cover. And as their exposures reduce, we look into the opportunity to obtain premium reductions.
Yeah, absolutely. Core part of what we do. So that's good insight. Let's drill into capacity issues a little bit deeper. So, Kevin, you mentioned accessing capacity is a real challenge right now for some of the largest risks. Tell us a bit more about what's driving that.
I have to say this, that whilst rate is a very big concern, capacity reduction to me is the most concerning challenge we're facing today. Most carriers are limiting capacity, and particularly, as I've said earlier, in large risks. And, in many cases, for instance, 2 or 3 years ago, when they were anxious to use as much of their capital as they could, they were taking on 100% of the exposure on large risks. And in many cases now, when we're looking at renewal terms, they're looking at reducing from that 100% capacity down to 30 or 40% capacity, and also wanting higher rates for that reduced capacity, wanting higher deductibles and self-insured retentions, and just all sorts of other changes to terms that are tough on clients, but probably necessary to help bring the business back to the level of profitability that's necessary to make it viable. It's forcing us to look at different avenues of securing the coverage. When it's not available domestically, we're having to look at, offshore coverage and sometimes unlicensed carriers, which we do try to avoid, but sometimes it's the only way to get the coverage that the clients needs. And, where excess coverage beyond traditional quota share is required, because of the fact that the market is in the shape it's in right now, that excess cover is not cheap. So we're finding that where we would have expected excess layers to be a lot more affordable, in some cases, the rates they're charging on the excess is just as high as that on the primary, where the majority of the losses are going to happen. So, we needed to create a lot of very unique and creative capacity structures. Simple structures just on the large risks don't seem to be working anymore to get the insurance covered fully.
Mm. I think you pulled up an example here of the kind of structure that we're having to put in place, which, you know, once upon a time was reserved for the largest multinational clients, but we're now seeing, you know, more of in the middle market space.
Yeah, this graph that we're showing here is an actual placement that we did out of one of our offices, and the vertical axis represents the coverage limits in the boxes, and the horizontal axis represents the percentage that each carrier is willing to take on. And you can see just on the vertical axis that varying carriers are comfortable, some with very low limits of quota share, some with very high limits of quota share. So we're having to piece things together. And in this case, we have 11 different insurers to place the coverage in a combination of different levels of quota share and different layers which they're attaching to in the excess. So it really, really becomes very complicated to place, and unfortunately very expensive as well.
Yeah. By the way, good effort on getting whilst into your commentary, Kevin. I know you're picking up on my English heritage there, so I like that. So let's talk about the third impact, which was COVID-19. You shared there some of the things that are impacting us. From my perspective, there's a number of factors in play here, and we're still learning every day how COVID is affecting our business, how it's affecting our clients, and how it's affecting the market, and how we navigate it. I'd make a couple of comments here. I think at a macro level, the impact of COVID claims on insurers is still unknown. The vast majority of business interruption claims have been denied, but there are a number of ongoing legal actions happening. It's actually worth noting this morning, back in the UK, there was a ruling on a test case where the Financial Conduct Authority brought an action against 8 insurers in the UK market as a test case to understand if coverage did apply in the event of COVID impacting a client's business. And that ruling is long, and I've only skimmed it this morning, but it does appear the court has ruled that there is some coverage in place for very specific policy wordings relating to disease. And I've no doubt that ruling will be appealed. So we're far from the end of this, but it's an ongoing challenge. I think it's also worth noting that, maybe in the bulk of our business, we haven't seen a lot of claims paid out, but reinsurers have paid out a lot of claims for event cancellation, travel cancellation, and the like. And all of that is causing a restriction in reinsurance capacity, an increase in pricing, and as you mentioned earlier, a tightening up in wording. On the wording point particularly, Kevin, what's that doing kind of in the real world and in your world?
Well, Dave, most insurers, a lot of them had their reinsurance renewals in end of June, and the reinsurers had them insert specific pandemic exclusionary wording in. Others that have not yet renewed their reinsurance have voluntarily put that wording in, but at the very least, when they renew, they know they'll have to put it in. So what happens, and it seems like it shouldn't be as much of a problem because everybody's putting more exclusionary wording in, but insurers are very cautious about following the wording of another carrier. When you have a quota share subscription, or when you're putting excess in a place that has follow form, you want to make sure you understand those wordings fully and review those wordings fully. So because of the wording changes right now, as subtle as they are, insurers are all wanting to review the wordings of other insurers prior to agreeing to subscribe with them. So what that does is it delays the opportunity for us to place quota share with a lot of carriers that that are maybe not comfortable with following another carrier's wording. So what we're trying to do is work with our insurers right now and say, here's the most common carriers that are leading for us where you're subscribing. Please review these wordings first so you can get approval on them, so we're able to place the coverage. It's tough enough with the tightened capacity to fill quota shares, never mind the fact that somebody would be willing to participate but can't because they don't, they're not able to follow that unapproved wording.
Yeah. What about the impact on our clients and the changes in their risk profile? I mean, we fought very hard in the height of the pandemic in the early days to try and get relief for our clients from things like penal unoccupied premises clauses, getting midterm changes in premium where the operations have changed, better payment terms. What's the situation right now?
Yeah, Dave, that's true. We reached out to the CEOs of our 10 largest carriers and asked them, for some thoughts on what they could do for our clients and how they could help our clients when we needed to. But, at the end of the day, I don't think that there was a whole lot of premium relief available. There were some, there was some relief in some personal auto where reductions were granted. But a lot of it has been a wait and see in terms of how it impacts the business at the end of the day. This pandemic period is obviously a point in time, and with some businesses, it has a very short-term impact, and then business will get back running again. In other cases, it's a longer term. So hopefully, as insurers start looking at renewals, they'll start to look at the reduced exposure and perhaps some relief from a premium point of view. They did provide some payment relief in terms of allowing delaying of some payment. The other thing that was challenging is the appetite for businesses significantly impacted by the pandemic. Things like hotels that were operating at very low occupancy or even having to shut down, where they had opportunities to perhaps help out in the pandemic, help out with providing rooms for non-critical hospital patients, those sort of things. Getting that material change in risk approved by the insurers was a bit tough at first. Businesses that repurposed to make masks where they normally made garments, those sort of things. Once the insurers got the feel of what was happening, though, they did, I think, in the overall, they cooperated quite well, and they realized that it was good for the client and obviously good for fighting the pandemic. The insurers have done a pretty good job of maintaining businesses as usual as well, in terms of being able to operate remotely, but sort of at the underwriting desk and claims. However, underwriters are working from home, and there's a reduced opportunity to do some things that would be normal course of business. We spend a lot of time with the underwriters, video conferencing and doing what we need to do to, get our clients' business in front of them. And, it's very tough because the underwriters, this is an unforeseen circumstance. Who would ever thought we'd be 7 or 8 months into this now? But underwriters' desks are swamped with business, and we're doing what we can to get our clients' business in front of them and get our deals done.
Yeah. That's a great observation around the actual impact of the process of broking, and I think insurers in the main, as you say, have done a pretty good job, and my thanks to them, my thanks to all of our team and our clients that have adapted to this way of working. So let's wrap up with a couple of things. I want to look at what we think is happening over the coming sort of months and years in terms of rates in the market, and most importantly, the best strategies to win in this market. So, Kevin, you spend a lot of time with the C-suite of our insurers, talking about how they see the market. And what are you hearing right now about the future?
Well, I think it's fairly consistent amongst the leaders of our insurance carriers that they do expect this hard market to continue on. Projections of hard market maybe for another 18 to 24 months post the main impact of COVID-19. However, rate increases will continue to likely slow a little bit because, as I mentioned earlier, a lot of our larger significant clients have had one or two cycles of increases already, and as well, I think. There was a bit of an exodus of insurers from the market, and we're starting to see hints of some insurers re-entering the marketplace. In the last 2 weeks, I've talked to two insurers that are considering re-engaging in the Canadian marketplace, and we're obviously pushing this agenda around the globe, and we're utilizing our Gallagher global connections and global resources to do so, really in support of our clients. And we know that when capacity is the biggest issue, we've just got to fight for our clients to get them what they need to feel comfortable with their coverage.
Yeah, I mean, like you, I feel that there is some, the market's becoming more sensible. The insurer CEOs I talk to regularly are seeing underwriting profitability return. They've still got challenges of low investment returns, uncertainty around the impact of COVID. So underwriting profitability is an absolute focus and will continue to be so. But there is more confidence to write new risks, and that's good for our clients, and gives me some encouragement that there are deals to be done out there. So on that subject, let's wrap up by talking about strategies to win in this market. You do need a strategy to get your renewal done. Maybe you can just share with us, Kevin, some of the best techniques and strategies you see to get the best results.
Sure. Dave, as I mentioned earlier, this is such a unique situation that we're in right now. And you combine that with the fact that the hard market was already fully in force prior to the pandemic. And as we said earlier, people haven't seen this kind of market for 40 years. We have a situation where premiums are increasing, obviously, so brokers and clients all want their business remarketed to make sure they're getting the best terms possible. So that's just in turn driving up the number of submissions that are going to the underwriters rather extensively. And those underwriters are working from home in a market that they've not experienced before, both from a hardening and from a pandemic point of view. And they simply can't quote all of the submissions that are coming across their desks. So we want to make sure that our clients' submissions get looked at. And we're working with our clients to put together better submissions, more detailed submissions. Why? Build the story on why this client is a client that somebody wants to write. I mean, the underwriters have piles of files on the desk, and sometimes they just have no choice but to say, this submission's incomplete, or this has one little thing that we don't like, so we're going to put that off to the side. We want to make sure that our clients' submissions are getting to the top of the pile and have all of the information in them so that they can get quoted on. And it's certainly really, really important to us. I mean, there's four really key things that make a difference here too, and we need to know first what's happening with our clients' business, updates. Is there any changes in exposures, any changes in values? We need to understand the insurer's position and intention. So we don't want to find out, for instance, 15 days before a renewal that the insurer who previously was insuring 100% of the exposure can only do 30% now. So we're getting out early to find out their position and their intention so that we have a good picture of where we're going to be at. When we review the information with our clients, we agree on a strategy for the renewal, and then we really proactively manage the renewal process and deliver the detailed underwriting submissions, give the underwriters all the data and information they need about the client's business. And we really, I mean, our job is to advocate on behalf of our clients and involve the clients in the process if they're prepared to be involved, because they obviously tell the best story about their business.
I think you make some great points there, Kevin. You know, the science of what we do is delivering the right information to the underwriters. The art of what we do is telling the story and differentiating our clients with the insurers, and using our expertise and our global capacity to make sure that we are getting those risks out to every insurer around the world that might be interested. And I think the other thing I would focus on is the criticality of relationships. You know, we're in a unique position where you know, we need to manage the relationship with the client, we need to manage the relationship with the insurer, and if we can get both of those right, we can really get deals done. I think I'll quote one of your phrases, which is, you know, this market is tough, but it is manageable. And I think with the right strategy and the right relationships and the right level of aggression and imagination, we can get some really good wins for our clients. So that's what excites me about the ability to still be able to differentiate in these market conditions. I'm going to wrap up. I'm going to say thank you, Kevin, for your insight. You know, I think your experience in this insurance marketplace and you know, the amount of time you spend talking to insurers and clients and doing deals it gives you a magnificent insight that I know you share with our whole team across Canada. So thank you for that. You know, thank you for that insight. And thank you to everybody that's listened into this. You know, a dynamic insurance marketplace is frustrating. It's frustrating for us, and I know it's frustrating for our clients. You know, we're looking for certainty, and we can't always deliver that. But I would like everybody to know that, you know, everybody on the Gallagher team is doing all that they can to try and get the best results every single day for our clients. So my thanks to everybody on the Gallagher team. My thanks to the insurers that work with us, and most of all, my thanks to our clients. You know, we truly are honoured, you know, to be your advisor, to be your partner, and to try and work with you. So thank you to everybody that puts their trust in us. As Tyler said in introduction, we will respond to any questions that have come through in the chat room, and I know there's been a few. And with that, I will say thank you and wrap it up. So thanks, everybody.